Hello once again. Let's talk about the economics behind market returns and consider how professionals have positioned themselves in response during the first quarter of 2023. I think you will gain clarity with this information we're about to cover. Looking back at the first quarter of 2023, pro-investors have handled this market in one of two ways. Statistics show most financial professionals, including corporate management and fund managers, have taken a cautious, long view. Meanwhile, a minority have speculated following near-term trends, come what may. Why have professionals taken a cautious, long view? Let's review the persistent headwinds facing the markets during the quarter, which has been a very volatile period of time. Continued concern about inflation has been a really big theme. We constantly hear about it. Meanwhile, the United States' economic strength has led the Federal Reserve to continue a policy of rate hikes to the point where the Federal Reserve short-term rates have risen to the level of now 4.9% at the end of March of 23. Yield curve, which is often a predictor of recession, has inverted. Let's take a look at these examples. This chart shows normal, flat, and inverted yield curves. Now let's take a look at today's yield numbers. You can easily see that short-term treasury bills like 1 month to 1 year pay much higher rates than the 30-year bond. This last chart shows the current inverted yield curve. Why does this matter? An inverted yield curve often forecasts a coming recession. Economics teaches us that as corporate earnings rise or fall, stock prices move along with those trends. Higher interest rates make capital more expensive, so earnings are expected to decline, leading to lower stock prices. Economic pain is likely because reduction in the M2 money supply is a big factor. Money supply grew over 40% from 2020 through 2021, which is the cause of the inflation we're now experiencing. The money supply has now tightened as interest rates have been raised. So inflation is slowing, but we are far from the Federal Reserve's 2% annual inflation target. For over a year, a debate continues about the timing, likelihood, and potential severity of a looming recession. Amidst all of this, financial markets generally ignore the geopolitical volatility factor. And let's face it, volatility of this kind is an elephant in the middle of the room, and it's very difficult to quantify. Thus, economists tend to stick to short-term economic measures as they reflect on conditions and they make their forecasts. Meanwhile, corporate management and investment professionals are measurably concerned, and this shows in their financial results. You have heard that 100,000 people have been laid off in various industries led by tech. And consider the measurable results in stocks during the first quarter, which reflect corporate management's reality. Among over 3,200 listed stocks tracked by Morningstar, only 27% of these beat the volatile S&P 500. 73% of these did not perform as well as the market. And what about the professional investment managers' results as reflected in the mutual fund performance during the first quarter? Among nearly 25,000 mutual funds tracked by Morningstar, only 16% of these beat the S&P 500. 84% of these did not. Even legendary investor Warren Buffett's Berkshire Hathaway Class B shares made zero progress, closing the first quarter with a slight loss. Given this evidence, now you can be more objective about what happened in the first quarter. So a key question arises. Should you be upset if your investments did not track the volatile markets during the first quarter? And would it have been wiser to speculate and take more risk? Or should you accept lower returns as an investment professional is taking a longer view? But why should you do that? It is possible by year end, levels could be lower than they are now. So the question is, how do we move forward? While hindsight is 20/20, the best approach to investment management is to routinely dispense with prejudice. We have to constantly refresh our view of emerging conditions. This can lead to better choices based on the best new data rather than blindly following outdated prejudices. Prejudice might mean that we err on the side of caution and could ignore trends. And prejudice might mean that we err on the side of speculation and wind up in a disadvantaged position. So currently, I believe it's best to take a hybrid approach in this environment. If you are watching what we are doing with our portfolios, you'll see us exercise a mix of caution while we remain sensitive to emerging trends. As always, contact us with your questions, including those about what to do about your employer's 401k or 403b or thrift saving accounts, and we'll help you manage your way through this. And thank you for your attention.